My name is Essang, and I'm a researcher at the Center for the Study of Economies of Africa. And today I will be speaking on certain areas of the tax reform bills that were submitted to the National Assembly by the Presidential Committee on Fiscal Policy and Tax Reform. The tax reform bills basically is proposing a change to the existing tax structure in the country to allow for efficient and fair tax collection and to reduce tax evasion. Some of the key changes to the current Nigerian tax system include company income tax reduction from 30% to 25% over a 2-year period, complete elimination of minimum tax for companies having no profit. Now, companies with an annual turnover of 50 million and below are exempted from paying company income tax, increase in VAT rate from 7.5 to 10% and then 15% by 2030, adjustment of the current VAT sharing formula and derivation, zero tax on over 600 food items, healthcare, baby care, sanitary products, electricity generation and renewable energy, zero tax on export of services and intellectual property exports. Now, individuals earning up to 800,000 naira annually are exempted from paying personal income tax. There is also tax exemption on compensation for loss of employment not exceeding 50 million. And then there's also the creation of the Office of the Tax Ombudsman for all tax-related disputes. Planned reduction in company income tax from 30% to 25% will stimulate the economy in a number of ways. Now, one of the key ways in which it will stimulate the economy, it will lessen the burden on companies to pay tax. Now, when that happens, these companies have a high tendency to grow. Organically, when companies grow, they employ more people, and then that will eventually, in the long run, reduce unemployment in the country. The proposed increase in VAT from 7.5 to 10% and then 15% will boost government revenue. When this happens, government will be able to fund a lot more developmental projects and provide social services ranging from free healthcare, free education to the populace. Now, individuals earning up to 800,000 naira annually will not pay personal income tax, which means low-income earners in that minimum wage category get to keep a lot of the money they earn. This now makes available a lot more disposable income for them to spend on the zero tax basic items, stimulating economic activity in the process. Also, small and medium scale enterprises with an annual turnover of 50 million and below will be tax-free. What this means is it reduces the tax strain on them, allowing them to employ more people and the business grow. Now, in the long run, the multiplier effect of this is enormous. According to data from International Labour Organization, small and medium scale enterprises currently contribute 48% to Nigerian GDP by generating economic activities through job creation, production of goods and services, and innovation. Under the tax reform bills, small and medium-scale enterprises will not be subjected to withholding tax. Now, what this means is they would get their full earnings, and in the process, this will improve cash flow for the business. Now, small businesses in the manufacturing industry will enjoy extended relief period, 10 to 20 years. In this context now, this will improve local production for some of them that are in the agricultural sector, ensuring food security for the country. It is also important to note that SMEs that face tax-related disputes, misunderstandings, either with tax officials or tax-related financials, will have it resolved in 14 days. The new tax reform bills makes provision for that. What this will do is reduce uncertainty faced by these small businesses. The tax reform bill mandates that businesses must adopt electronic invoicing and not paper invoice. Now, this will help reduce incidents of invoice manipulation, faking of invoice figures so as not to pay the full tax. The tax reform bill also mandates that every taxpayer in the country, individuals and businesses alike, must have a tax identification number. Now, this tax identification number allows for the tax authorities to link taxpayers to a digital tax profile. Now, with this tax profile, these taxable individuals will not be able to evade paying their taxes. The tax reform bill allows for the deployment of an electronic fiscal system. Now, this electronic fiscal system mandates businesses to report their transactions electronically. This ensures that transactions are recorded in real time, it reduces manual error, and it reduces the chances of these businesses evading tax. In addition to the electronic fiscal system, the tax reform bill makes provision for the tax authority to deploy digital tools, softwares, electronic payment processing system, so as to be able to capture tax from digital transactions in such a way that tax is automatically deducted and remitted to the government. The tax reform bill is not without its own challenges. Now, one of the challenges revolves around the digital tax system, which requires the adoption or deployment of electronic fiscal system. For this electronic fiscal system to operate smoothly, it will require reliable internet and electricity. For taxpayers in remote locations, they may struggle with limited internet access and electricity, making digital tax compliance and electronic invoicing very difficult. To address this issue, the tax authorities can introduce offline filing options or provide reliable internet and electricity in these locations. Another major challenge is the fact that taxpayers may resist the digital tax system due to lack of awareness or fear of increased tax scrutiny. Now, to address this, tax authority can provide regular public awareness campaigns or regular trainings that educate taxpayers on the essence of digital tax compliance. Lack of seamless data sharing between tax authorities, customs, banks, and other relevant agencies is a challenge because this makes tracking taxable income very difficult. To address this challenge, it is imperative that the tax authority create a central database that captures or integrates data from all of these agencies such that tracking taxable funds is made easy. Resistance from regions benefiting from the current VAT formula is a major challenge. Now, these regions receive much more VAT than they generate and have mounted a strong opposition to the formula as proposed in the new bill. To address this resistance, deliberations between leaders in this region and the fiscal committee is highly encouraged. Some state tax agencies lack advanced digital infrastructure, the digital manpower necessary to effectively implement the digital tax system as proposed in the tax reform bill. Now, to mitigate this, tax authorities can provide regular training for their tax officials on how to navigate and use these digital tools. On a final note, transitioning from the current tax system to a new system will take time. However, it is important that implementation is done in phases to ensure a smooth transitioning with minimal disruptions.